Good afternoon, everyone. My name is Michael Mandarino, and we have Travis Wesley here. We're excited to welcome everyone to life insurance planning for retiring and separating service members. Travis, you want to go ahead and introduce yourself?
Yes, everybody, welcome. Those of you who are retiring, I just want to say congratulations on your upcoming retirement. Welcome to the club from one retiree to another. I retired in 23 from the Army, got into life insurance shortly after that, and happy to be here to help give you guys some knowledge on life insurance options so you can take care of your family and financially prepare for retirement and further down the line.
Yeah, and my name is Michael Mandarino. I've been a life insurance agent since 2002. I've been helping servicemen and women when I started my practice overseas in Germany. So I think together, our goal today is really to just teach you, to show you that there are other ideas uh, within the government and outside of the government, and those are the main things we're going to be discussing today. And a little housekeeping notes. There is going to be a chat function where you can chat any questions. At the end of our webinar, we will be answering any questions, whether it be via text. So please go ahead and text or chat your questions with either in the chat or in the Q&A section. And then if we do have time at the end and those who want to come offline and actually talk with voice, we can do that as well. So, but we're so happy everyone's here in attendance. So thank you.
Military transition timeline. This is kind of what you about 24 months out. Some of this stuff you guys have probably already done. 18 to 24 months out before retirement or separation. Verify your leave balance. Make sure everything's already medically diagnosed and request medical documents. Talk with a life insurance agent. That way you can go ahead based off your medical and prescription history, see what you qualify for and kind of plan, for your budget. 180 days out, make sure you submit your BDD claim, benefits delivery at discharge, a VA claim. About 3 months out, make sure everything's done with CIF. You make sure no outstanding debts and make sure everything's good for processing for your DD 214. Next slide, Michael. Here's your pay timeline. About 20 business days post retirement separation, that's when you should receive this business days, your last military paycheck. If you don't receive it by that 21st business day, make sure you get on a hold of your local finance office and see what's going on. 30 days post retirement, that's when your retirement pay should start. About 1 to 20 days post separation date is when you should receive your VA rating. Sometimes there's outliers. It takes as long as 90 days, not often. I received mine about 5 days after my retirement. The next month after you receive your VA rating is when your disability pay should start. Next slide, Michael. These are the three major life insurance planning concerns. Everybody tends to plan for the option on the left. What if I die too soon? We're going to talk a little bit about what if I live too long and what if I get chronically ill. So you have a plan for all three. Next slide, Michael. Typical reasons for life insurance disqualification. This is for commercial life insurance. A lot of stuff you see on here is severe stuff. But the main thing, if you don't have anything severe, for mental health, PTSD, depression, anxiety, and TBI, which a lot of veterans get, as long as it's not severe, you should be able to qualify for commercial life insurance. There's a myth that if you have a 100% VA rating, you cannot get commercial life insurance. That's not true. I've done 3 or 4 policies already this year for retiring vets with 100% VA rating, got a policy, no problem. A couple even got preferred rating, which is the highest you can get, the healthiest you can get. So as long as your depression, anxiety, PTSD, TBI, whichever one it is not severe, you should be okay. Next slide, Michael.
Yeah, and just to reemphasize this, when you're applying for a policy, typically there's either non-tobacco or tobacco rates, and then there's standard, preferred, and preferred plus. But there's also ones that are like table A, B, C, D, and E. That means that you're actually having to pay more for your policy. So that's just meaning you're considered rated up on that policy. Here's the next slide, Travis.
Thank you. If you are expected to get SSDI, where you can't work full time, you can only work like 20 hours a week, most likely you will not qualify for a lot of commercial life insurance companies. It depends. If you had a severe mental health, like hospitalization, suicidal ideation, or suicidal attempt recently, last year or so, there's probably a time period, 5 to 10 years, where you cannot qualify for a commercial life insurance policy. So just kind of in the meantime, you gotta have a current driver's license. Other than that, as long as you don't have anything severe, you should qualify for a commercial life insurance policy. Next slide. For retiring veterans, if I have anybody on here that's not retiring, these are your 5 options to take care of your family when you pass away. 3 government options, 2 commercial options. For those who are not retiring, you don't have the survivor benefit plan. That's only for retiring veterans. We're going to break down each one. That way you can compare and contrast pros and cons of each and see what's best for you and your family. Next slide. All right, terminology. Term life insurance is a term, temporary, 10 to 30 years usually, where if you pass away during that term period, you're covered and your family gets the death benefit payout. Now, what you have to consider here is lower costs initially, but if the term expires after 20 years, after 30 years, you either have to renew or convert to a permanent policy, and the cost of insurance then could be, pretty expensive. So you have to take it into consideration. SGLI, VGLI are both considered term policies, even though VGLI can continue as long as you pay the premiums each month. Next
And,
slide, Michael.
statistically, with term life insurance, most of these policies, only about 2% of these policies ever pay out. I was a veteran, so was Travis, so we had SGLI, so we're part of that statistic. But most folks will outlive their term life insurance, which is a good thing. That means that you're obviously living beyond what you thought you were going to live.
Thank you, Michael. The next one is permanent life insurance, also known as cash value life insurance. This is meant to cover you for your entire lifetime. Now, this could be, some go all the way to age 100, some go all the way to age 120. The main 2 that we're going to talk about here is index universal life policies and whole life policies. Both of these come with a cash value element. One is kind of linked to an index like the S&P 500, not directly tied to the stock market. And another one gets the cash value builds another way. These are considered tax advantage policies where you can actually withdraw from tax-free, builds a cash value that you can access anytime. These are considered, they're at a higher cost, but they remain in force for your entire lifetime. So there's a reason why. Next slide, Michael. All right. This is the first government option, VA life insurance. This is a whole life policy, $10,000 to $40,000 death benefit. Long as you have a VA rating, regardless of medical conditions, you can get accepted for this. No medical underwriting. The cash value adds up after 2 years after the approved application, and the premiums never increase. And this one comes with a cash value. So it's you're paying into monthly, but you also have cash value that you can borrow from or take loans out whenever. Next slide, please. Veterans Group Life Insurance. So within 1 year and 120 days, you can convert your SGLI to VGLI. Within 240 days post-separation date, you can convert to the VGLI at the same death benefit or less than. No questions asked medical. So no medical underwriting, no exams. So this is crucial for those who have a serious medical condition. Maybe you just got diagnosed with cancer, maybe diabetes 2, just had a stroke. Whatever it is, you are accepted with that 240 days post-separation. So it's a great option for that, for those who have serious medical conditions. This is only death benefit, no cash value. And as you see, the premiums increase every 5 years. Also, every 5 years, you have the option to decrease the death benefit. You have to keep in mind that if you are insurable and like you're in really good health, the cost of this long term may not be in your best interest. But for those who have severe medical conditions, this is a outstanding option.
And this is a great option for when you're initially getting out and you're in that transition. We typically recommend to our clients to keep it for the first 5 or 6 years until it starts getting unaffordable. Because again, as you start working and with inflation, you may end up needing this coverage later on. And what Travis next is going to show you is how we have the ability of actually converting that as well.
Thanks, Michael. So upon your conversion to VGLI, at any time, whenever you want to, you can convert that policy without having to go through medical underwriting to a whole life policy. So anytime you choose to do that, you pay for the whole life policy, you pay for 20 years, you're covered all the way to age 120. This builds a cash value, considered a tax advantage strategy, where you can access the cash value at any time. There's no required minimum distributions. And you can take loans out or you can withdraw. The loans are usually 5.5% or less. Usually by year 17, the cash value exceeds the premiums paid into the policy. And usually by year 80, you have over $1 million in cash value. This is an outstanding option for those with severe medical conditions, especially those who have a high probability of living decades. Maybe you have a cancer diagnosis and you have a probability of living the next 3 decades, where instead of having that long-term cost with the VGLI and you get no recoupment, this right here, you can recoup your premiums paid into the policy with the cash value accumulation.
And this is a government program that does allow for that guaranteed conversion. So we do work with multiple carriers that we can help you convert that policy for you. And you can also convert your service group life insurance directly to a whole life policy as well before you get out.
This right here is kind of give you an idea what term life insurance rates will be. This is for non-tobacco user rates. Now, if you are a tobacco user outside of the nicotine gum, outside of chewing tobacco, outside of the nicotine patch, other than that, you will pay a higher premium than this.
And Travis, we did have a question, and it comes at different rates. We do have different carriers that consider smokeless tobacco or even pouches not as tobacco. So there's just things when you work with Travis and I, let us know. And then we have carriers that will be more lenient when it comes to those types of tobacco products. And same thing with cigar usage. It's typical that you can have a celebratory cigar once or twice a month. Again, just always disclose that to the carrier, but that's never really an issue unless you're smoking cigars daily.
Recommendations for term life insurance. A big thing with term life insurance is you always want to have a plan for after the term. So say you have a 30-year policy, you're a 40-year-old, and you reach age 70 and you no longer have life insurance, and you're like, man, I need life insurance now. My term policy expired. The last thing you want to do is come see me or Michael at age 70 for life insurance, because that you're probably going to pay, if you're looking for the same death benefit, $500,000 or whatever the death benefit amount is, you're probably going to pay upwards of maybe $1,000 a month or more. If you're even insurable, you may not be insurable at that time. So always have a plan for after the term. Also have what's called a guaranteed convertibility option. What that means is, say you get in a car accident year 10 after having your policy, maybe you're disabled in a certain way, maybe you're cognitively impaired, maybe you cancer diagnosis, whatever, you can convert that policy to a permanent policy at the same health class rating as when you bought the original policy. So where you may be uninsurable, you have that convertibility option, you're covered, you can convert to a permanent policy whenever you see fit. A timing tip, it's in your best interest most likely to purchase a term policy prior to submitting your BDD claim. One, because a term policy can be affordable. It's not really going to set you back too far budget-wise while you're still in. And before you go about the, the activity of trying to accumulate as much medical to get that 100%, you get tunnel vision, and you might accidentally make yourself uninsurable. You already have a policy in place.
And also with that is one of the questions on most insurance company applications is, are you currently getting disability from any source? And of course, that would be yes once you do start getting your VA disability.
All right, here is a side-by-side comparison, 40-year-old, $500,000 death benefit for each one. This is going to really show you the long-term costs of a VGLI, 30-year term, and index universal life policy. So on the left, 40-year-old pays into the VGLI for 40 years from age 40 to age 80, $500,000 death benefit. It's going to cost around premiums $280,000 total, a little bit over. For a 40-year-old, 30-year term costs around $34,000 accumulated premiums over that 30-year time span. Keep in mind, though, if they have to convert to a permanent policy or renew the term at age 70, you're definitely adding more costs to this. So you definitely have to factor that in. Index universal life policy. This policy is not linked to the stock market, but it builds a cash value. It's linked to like the S&P 500, an index. Builds a cash value. Total premiums over 30 years. You pay into it for 30 years. At age 70, you stop paying into it. Around $160,000 total in premiums. You have, by age 80, if you live that long, about $300,000 plus in cash value, and it covers you all the way to age 100. So you see side-by-side comparison, VGLI, term, and index universal life, and kind of what might be best suited for you long-term.
And the policies we work with, you can actually structure them a lot differently as well. So, in this example, we had it being paid up in by age 70, but you could extend the payments beyond age 70, which would lower your monthly premiums, but you would continue paying beyond 70 up to either age 100 or even up to 120 for that, for some of the policies. So one of the things that you're going to have the decision to make for those that are still on active duty, and it's actually going to be your spouse's decision, is do we or do we not take the survivor benefits plan? So you can read on the slide there. It's a program created by the Department of Defense providing a monthly cost of living adjusted income to eligible survivors for the soldiers, sailors, airmen who die on either active duty in the line of duty or as a retired soldier using the survivor benefits plan. Again, this is an act that you have the option to choose. And when it comes to the choosing options, there's different levels of it. But in our case, we're showing just a full, for an E7, E9, and an 06, roughly what the cost would be if they choose the survivor benefits plan. So the survivor benefits plan is approximately 6% of your retirement income payable for 30 years. So for an E7 retiring, with a monthly retire, pay about $3,000 a month. We're estimating the cost over 20 years would be about $62,000, and then the cost over 30 years would be about $111,000. Then you're done paying for it. For the E9 monthly paycheck, retired check of $6,000. The monthly cost is going to start at $309. Again, it does increase by the Consumer Price Index potentially every year when that increase does happen. So this is just estimated over a 30-year time period. And then for that 06, again, if you're not any of these three ranks, get with Travis and I, and we do have calculators can help you kind of really calculate and make the best decisions. But for that 06 with $9,000 monthly retired pay, the monthly premiums are going to be about $585 starting, and then over 20 years it's $188,000, and over 30 years is $333,000. So again, it does provide an annuity payment of 55% of the retired's pay per month. It does keep up with inflation. You can choose beneficiaries. It can be the spouse, your kids, or even spouse and kids, or just kids only. Kids are covered through college. And if incapable of self-support, low function, autism, cognitive impairment, and disability. Premiums for spouses, again, 6.5% of retired pay, and possibly between $5 and $8 per month for children. The major downside is if you choose a spouse-only option and the spouse dies before the retiree, you could have paid all this money and have nothing to show for it. So an example would be is that E9 lived 30 years beyond the military and his spouse died at year 31, he or she would have paid $222,000 into the plan and have nothing to go back to their estate. So that's where a lot of the folks that we work with, they want to see what other alternatives are there. Now, this is a really good plan if you're not insurable. Again, that's one of those reasons, going back to where Travis says, is let's try to get you a term insurance policy that's less expensive initially. That way you can convert that over once you do retire and once you figure out what your finances are. Because you're either going to take, when we work with clients, we either want you to take the survivor benefits plan or have a permanent life insurance policy in force. Because again, when the military service member passes away, so does all their benefits unless it's protected. So many retirees pay $100,000+ in the SBP over 30 years. SBP again is fully paid after 30 years and after age 70.
So for those who retired at age like 38, you do have to pay into it for like 32 years. You have to make sure you're at least age 70. So just keep that in mind.
Thanks, Travis.
Yep.
So what does a survivor benefits plan kind of look like? So for that military retiree that's getting $3,000 monthly paycheck, this isn't including VA, and this also is not including the potential next career. So that monthly paycheck, as you can see, initially would be for the surviving spouse, $1,287. This is taxable. So this is, Travis, we're taking out the taxes on these, correct? I believe.
Yeah, this is after the taxes.
Yeah, so these are after tax numbers. So as you can see here, that one of the big advantages is it does keep up with inflation. So you can see here at year 30, that E7 spouse would be getting $3,000 per month as far as the survivor benefits plan check. So you can see here the cumulative returns right here as far as on the left-hand side. And again, we'll go through that same breakdown for the E9. Again, 55%. So you can see here, that's a big chunk. If you're used to getting that $6,000, that's a big difference, 55%. So a lot of times you can even get survivor benefits plan and life insurance to be able to offset that difference of 45% they're diluted. So there's many different ways of working with, but most importantly is to do something. And again, you can see the cumulative totals. So for that E9, if the spouse, the military member died early, by year 30, that spouse would have already collected $1.469 million. And again, for the 06, same thing for, you can see here where it starts, $3,700 a month. And then you can see where that does increase and grow to. So again, cumulative returns. So there is typically, when we look at how do we replace the retiree's pay, a lot of times when you look at that, somewhere between that year 20 and year 30 cumulative numbers is normally the amount of life insurance that's required. I've been doing this for 25 years. And when I work with, my clients who are actually on active duty getting out, those are typically, it's going to be somewhere between that E9 is going to be needed somewhere between about 800 and 1.4 million of coverage. And then for that colonel, 1.2 to about $2 million of coverage just to replace the military pension, not to do anything else. So what are the advantages of SBP? Number one, it will leave a guaranteed income to your eligible beneficiaries up to 55% of the retiree's elected coverage. It is inflation index protected. So it is based off the consumer price index. It's not affected by age and lasts until the spouse dies. You can pay for SBP with pre-tax payroll deductions. So it's taken right out of your retired paycheck. You do not have to be insurable or have proof of good health. Obviously, that's one of the most important. This is a general program that's provided by the Department of Defense. That is, everyone who is retiring is eligible. Obviously, if you're not retiring, the survivor benefits plan is not available. If you're just transitioning out, you absolutely want to be looking at some type of commercial alternative. SBP is applied at no cost while on active service. So that is, you are actually getting that while you are on active service as well. If you outlive your spouse, big disadvantage of SBP. No one gets the benefit. And this is really when you sit down with your spouse, if he or she doesn't know this, that's really where the bells and whistles start going off and realizing, okay, what are our alternatives? Because, in a lot of cases, the military service member is potentially in better shape than their spouse. So again, you could pay in this program for 30 years and no benefit is going to be paid if your spouse dies before you, or if you die like the Notebook and you both die together, then again, nothing is going to be paid out to your estate. So, we really think there is an alternative to SBP if you are insurable. The cost during retirement is a monthly deduction of 6.5% of your retired pay. Once you enroll, changing election is very difficult. It's typically only done between the 12th and the 36th month. After that is irrevocable, meaning you cannot change that beneficiary. Life insurance alternative advantages versus SBP. It's payable regardless of who dies first. It can be left to your children, your favorite charity or church. There is cash value available. So one of the policies we work with that, you can pay into this policy for 20 or 25 years, and the company will guarantee that you at least get what you put into it back if you decide you don't need the life insurance, or you're getting back a higher of the cash value. Again, those are very specific. So, work with Travis to really figure out, your own personal situation and what it comes to that. It does provide tax-free growth. So one of the advantages of life insurance, it does pay out tax-free to your beneficiaries. It can also be reused as a retirement source of income. So a lot of our clients actually like to use life insurance as an asset class. There's a lot of information online through YouTube about using life insurance for different types of retirement planning. If you want to search that or talk to one of us, we'd be more than happy to teach you about that. And also you can decide to cancel it every time. So obviously with SBP, after your third year in it, you no longer can cancel that, and you're going to be paying that until those next 30 years. And then premiums can be adjustable. So those are things that, we, in a slideshow we showed earlier, we did show that we were paying your policy off at 70. You're going to be paying less over time. But if you want to extend your premiums out to age 100, you'd be paying less in the beginning, but you would be paying more over time. So there's a lot of flexibility and adjustments that can come with those premiums. Now, what are the different disadvantages of life insurance? Well, the big one is you have to be insurable. You have to be in good health. If you're a tobacco user, that's absolutely going to be affecting your rates. I do have clients that have gotten tobacco ratings because that was their main option. They'd rather do life insurance than SBP. But the good news is, if you're only using tobacco, I've had clients quit using tobacco when you realize how much money you can save on a monthly basis, in addition to the cost of cigarettes and, of course, your health. But, we can actually show you, our companies we work with, after you're smoke-free for a year, we can get those rates lowered, assuming there's no other change in your health. Most likely, the life insurance is going to be more expensive, especially if you're well into your mid-40s and approaching 50s while you're getting ready to retire. So those are all things that we do talk about planning early. With life insurance, the earlier you plan, the less premiums you'll be paying over time. If there's an early death, SBP can be a much payout over the long term because it is inflationary protected, and that obviously is going to be a big portion there. If you stop the payments, your policy absolutely could lapse or could be canceled, and your premiums are taxable, so there's no tax advantage paying those monthly premiums. So here's one of our alternatives. So if we have a 35-year-old male, now this assumption is preferred ratings. So in this case, we're looking at getting a $1.2 million death benefit. Now, if you multiply that by 5%, we're looking at, and again, this is an assumption that if you put $1.2 million and you put it into an investment, or a bank account or something that pays around 5%, maybe an annuity, whatever that looks like, that would be paying $60,000 a year to the survivors, not touching the principal. So obviously you can touch the principal, it's your money. But what does that cost over 30 years? It's $250,000. So that cost per month would be $694 per month to be able to provide that 35-year-old preferred male at $1.2 million death benefit. So for those females that are on the call, the good news is your rates would be lower. So if you're a preferred rated female, your rates are low because based off of mortality tables, you most likely are going to live longer than most men. What's really unique about life insurance, it does come with a potential cash flow. Again, this is not guaranteed, but in this case, we showed an index credit, and we don't have a lot of time to go into different indexes here. That's definitely scheduled that with a personalized call. But after 30 years, you have $349,000 potentially in that account. It could be more, it could be less. But again, when you're looking at your cost of $250,000, you have the ability of actually earning over $100,000 more in this type of policy. And just as a reminder, we do have some questions there. We will be answering these towards the end. So again, going back to that 35-year-old male, total cost of SBP for 30 years for an E7. This is the $111,000 for an E9, $122,000 for that 06, $333,000 for that 30 years. Cost of insurance is right in the middle, so that's about $250,000. Again, we feel there is an advantage of having that life insurance because you own the policy, you own the cash value that's in there as well. So you can see here for the E9 SBP, how does it compare? It is less expensive, $138,000 less expensive than the premium insurance, $27,000 less expensive and the SBP, and then $83,000 less expensive for the life insurance for the 06. So permanent life insurance does have the projected value of, again, that $349,000, again, assuming a 5% rate of return on that index strategy that we would choose. Now, this is a 44-year-old male, so just to show you a little difference, we still want to get that same $1.2 million. Again, when you work with a life insurance agent, we're going to help you really figure out how much insurance you need. But again, we're really, in this case, we're showing you, the survivor benefits plan versus life insurance. So again, this is going to be providing a $60,000 a year payout to the survivors. And, you may say that's not enough, or you may say that's too much. So those are really where, when we start looking at your personal lifestyles and your cost of living and how you're spending on a monthly basis, then we really do what's called a needs analysis and really help you there. So in this case, for that 44-year-old male, total paid up cost at age 30 years is $368,000. Cost per month is a little over $1,000, $1,022. Again, we also like to think of, if you were to get this insurance in place and then you're getting a VA disability rating of maybe up to $40,000 or $50,000 a year, that's a fraction of what you're getting from your VA disability. So we like to really kind of show you, to start offsetting some of that VA disability and taking care of your family long term. So again, the nice thing about life insurance, it does come with a cash value, which is not guaranteed, but in this case, we were estimating in 30 years being worth $516,000. So here's that comparison for that 44-year-old male. Cost of SBP, again, those numbers haven't changed. However, the cost of insurance absolutely did change. So again, that's the risk versus reward. Do you want to take the risk that you're going to outlive your spouse, or do you want to have something that you really control? And that's really where the fine line comes to when it really comes down to the survivor benefits plan versus life insurance. Obviously, the big thing is, can you get life insurance? Are you insurable? But also the cost. So you can see here that the SBP option is going to be a lot less expensive for both the E7 and E9, and it's not much more expensive for that 06. So really, when you start looking at the numbers, again, let us help you doing that deeper dive when it comes to that. So SBP recommendation, we recommend you have a plan before you get out. We recommend you either take the SBP option or get a permanent life insurance in place before retirement. Your spouse is going to be the one that, if you're going to deny SBP, they're the ones who have to actually go to your class and actually sign off that you're not accepting, that he or she is not accepting a survivor benefits plan. But again, take care of your family, make sure you have something in place. And you can also do a combination of both SBP and life insurance. We always recommending having one or both in place.
All right. We've already talked about some of these 4 options. Actually, you can add to this the survivor benefit plan. We talked about 3 of them: the Veterans Group Life Insurance conversion to a whole life policy, Veterans Group Life Insurance, and VA Life. All 3 of these you can take. Just got to make sure for the VGLI, 240 days post separation date, that's your window to convert from SGLI to VGLI with no medical underwriting. VA Life, long as you do it before age 80 and you have a VA rating, you're good to go. And the conversion, VGLI conversion to whole life, you can do that at any time you feel like it after you have the VGLI. The 4th option is a guaranteed issue final expense policy. This is where you have very little bit about a death benefit, usually no more than $25,000. And it's pretty expensive considering how little death benefit you have. But the good thing about it is you're guaranteed issue, you're guaranteed to be accepted regardless of medical issues. So you can have cancer, diabetes, stroke, heart attack, whatever, and you'll be covered with this. Guaranteed issue final expense policy is mainly good for final expenses, take care of a little bit of debts, the burial, and that's about it. So these are your 4 options in addition to the survivor benefit plan for those with severe medical conditions. Employer life insurance, we didn't list this as an option because it should never be your standalone option. Employer life insurance, there's a condition with it as long as you are working with that employer. So say you want to work at Home Depot or JP Morgan, wherever you end up getting employed at, they may offer life insurance, but it's on the condition that while you're working there, that's a benefit. As soon as you either quit, get laid off, go somewhere else, 2 weeks, maybe 4 months, you no longer have life insurance. And it's also, you don't really have flexibility. It's not your own policy. It's a group policy. So you can't really, set the death benefit amount that you want. It's kind of, you have like maybe 2 options or only 1 option. So, but it is pretty cheap. If you guys
that ends a formal part of our presentation. This is our contact information, and also you can see our information is in the setup and meeting with Travis or myself. Go ahead and click on the link that's there. But we do have some questions we want to answer in the meantime. So for those that want to stick around, please don't hesitate to either type in your answers. For those that want to come off and actually ask the question live, just go ahead and raise your hand. But we do have a couple questions first. So, Donald, you asked regarding the IUL, if that 300K is pulled out by age 80 and passes away at age 81, does the family get the full life insurance? And I want to make the assumption you're saying pulling out, meaning you're taking that cash value out. So if you borrow the cash value that's there, your insurance policy will pay minus whatever cash value pull it out. So that loan, you can take a loan off of these policies. So in the example that we were using, I think what you were referring to, and Travis, that 300K option, was that the 1.2 million we were referring to? I believe.
No, that was the side-by-side option. It's $500,000, and we put on there that it's about $300,000 cash value at age 80.
Okay, yeah. So in this case, you can actually borrow up to like 290, let's say 280,000. And then the death benefit would be 500,000, whatever your policy loan would be. But if you ever to just cash out of the policy, then of course the policy does, you do lose the policy at that point. And I do see another question, Don. That was a great question, Don. Another one was disadvantage of SBP. If the spouse and service member passes away when the children are 18, do they still get the money? Travis, you want to answer that?
They can still be covered if they are enrolled in college through college years. If they are incapable of self-support, like low function autism, etc., they're covered for life. So in both those cases, just as long as they're eligible. And yeah, but after say college years for a neurotypical child, then they will no longer be eligible for the survivor benefit plan.
Perfect. And then for those that didn't see the answered question, we answered it was the question was definitely interested on how nicotine pouches account in a tobacco policy. Is that a company determining the difference or something along national guidelines? Plus, what if I smoke a cigar maybe 3 to 4 times a year? So again, another great question. So I actually just had that exact thing happen with a client of mine. Him and his wife were using the nicotine pouches, and they came up as a tobacco user with one of our carriers, which had a very large rating. Wasn't, so what we ended up doing is we took that rating and we went to another company we work with that is more lenient when it came to the pouches. So we absolutely were able to almost cut his premiums in half. So the more you disclose to Travis and I when we're going through our initial consultation, then we can know that. So for instance, if you have like a heart murmur, or if you maybe are a cancer survivor, those are all things that let us know, because we have multiple carriers where we actually will shop to the different carriers and say, hey, we have an individual that's looking for $1 million of coverage. This is what we know about them. And then they'll go out and they'll actually start doing what they call a soft medical pull, where they'll pull your medical records with your permission and see what type of temporary option they would give you without giving you an actual medical physical. Most of our policies, we will have to be sending a nurse to take labs and a urine sample in most cases. So it's not every carrier, but those are a lot of the carriers. So, and then also the question about cigars is most carriers are okay with smoking a cigar a couple times a year. However, I did have a retiree that went for his physical, and he had a cigar party the night before. Well, guess what? He came up and with tobacco in his system, and sadly was not able to get the non-tobacco rate. So obviously, be wise when it comes to when you're doing your medical exams to not smoke a cigar right beforehand. But perfectly fine. In fact, I've seen even a couple times a month when it comes to cigars. Obviously, cigarettes are a little different, just along those same lines. Is now with the tobacco, whenever you quit the tobacco use, again, you can always go get those removed off of your policy. So, is there any other questions? Please either use the chat or the QA section. And for those that would want to come up and talk, we will just hit raise your hand. There is a part at the bottom where you can raise your hand, and we can allow you to come off and talk. Travis, did you have anything further on those questions that we answered?
No. Great questions, by the way.
Yeah, let's see here. Anything else? Yeah, we'd love to stick around if you have any more questions. So feel free to use us as a resource. When it really became pertinent to me was when I had my classmates that are starting to retire in 2016. They were going through their classes the end of 2014 and 15, and they just knew that there must have been another solution. And of course, you're not taught about what is that commercial solution. So, allow us to be a resource. We love teaching. We love helping you make decisions. One of the best things I can hear is I have a private meeting with a client after a webinar and say, you already confirmed what I already was going to do outside of that. And for us, that's perfect. We want to make sure we're giving you the best resources possible to take care of you and your family long term. Let's see. We did have another question. Are there any preferred carriers that offer no exam SGLI to whole life? Preferred. Yes, we do have companies that will go directly SGLI to whole life. It is a 20-pay policy. Travis, did you want to show those illustrations?
Yeah.
Okay, so let me share this. That's a great question. So let me stop my sharing and let Travis. So to answer your question, yeah, we do have companies. We don't like to talk about companies on our webinar, but we do have companies that will go direct from SGLI to whole life. The whole life if you're familiar with whole life, you can either pay for it for life, or you can do a 20-pay. And what Travis is getting ready to show you is what we call a 20-pay policy.
All right, can you guys see my screen?
Yeah, Travis, we got it.
All right. Okay, this is for a about to turn 44-year-old male, $500,000. This right here is the hold on, the annual premium. The death benefit goes up each year. Here's a death benefit, and then as you see, it goes up each year with the dividends with the policy. And here is the cash value in the middle. And as you see, by year 20, done paying into it, $317,000 over that 20 years. But by year 17, they have more cash value than premiums paid into the policy. And by
Actually, Travis, you go a little earlier. It actually happens in this policy. It happens a little earlier. You're looking at year 13. Right, year 12 is 191,000 over 190.
yeah, and then after age 80, usually over $1 million in cash value.
So what's neat about this policy, and this is for both SGLI and VGLI, is it is a 20-pay policy. And when you look at it, it's a investment into an insurance policy that has a growing death benefit. Number one, it keeps up with inflation. And number two, that cash value that Travis is just sharing. Travis, go up the next page.
Yep.
So although once you're done paying for it, to have with one thing that's nice about whole life policies is although the dividends aren't guaranteed, the carriers that we work with are always paying a dividend, and they've done so almost since the day they've started. But again, with any dividends, you can't guarantee future results. But based off of past results, you absolutely can know that there are dividends paying. So a whole life advantage of whole life is it's very consistent. In this case, for instance, Travis is showing at age 20, year 20, that person's 63 years old. They have $436,000 of cash value in that account. They could borrow from that cash value. Let's say they borrowed $400,000. That would still leave a $380,000 tax-free death benefit. But now they can take that $400,000, buy a second home, buy a vacation home, pay off their mortgage, whatever they'd want to do. We wouldn't necessarily recommend paying off their mortgage, but I like clients that like to use this for their investment purposes. So you can borrow from yourself and pay yourself back. So there's a lot of flexibility when it comes to, again, the 20-pay whole life. So yeah, that was a great question. So we do work exactly with companies that will allow you to, once you get a copy, we either verify you have SGLI from the ODIA, is that right? Travis, did I say that right?
I believe so.
Yeah, we have the instructions on our website that kind of walk you through that. But we help and sister. There's no medical questions. It doesn't have to be an annual pay. You can actually pay for this monthly. Most of my clients do pay for it annually, but if you pay for it monthly, it is a little more expensive, and that's with almost any insurance policy. You can pay for it yearly, just like your car insurance. You pay less over time if you pay it yearly. If you pay it monthly, there is a little extra charge when it comes to conversion. So Travis, you also want to go show the example of the 35-year-old whole IUL?
Yep. All right. So this is a 35-year-old IUL. This is the 1.2 million that we talked about, paying $694 a month. We set this up where they stop paying into it after 30 years. So age 65, that's how much they're paying into it, 250,000 plus. Then this right here, the death benefit does not go up. It stays the same, 1.2 million. You can structure this in many different ways, but by around year 24, should have a little bit more cash value than premiums paid into it. Year 25, my bad. And then it just continues to grow. They make it to age 85, over $700,000 in cash value. And even worst case scenario, like 2%, that means zombie apocalypse and the stock market's crashed and everything's gone to crap. This one still gets you all the way past age 100, as you can see on this side over here.
And that's a guaranteed death benefit. So this
Yeah.
policy we structure where you're just paying really the cost of life insurance. You're not adding extra money. For those that know about adding money to your cash value, this is just paying for the cost of insurance to guarantee the death benefit to 120. And again, and we can structure this however you want to structure this.
And then in year,
And Travis, go up, keep it on that page right there. So if you see those asterisks that Travis is showing, you've actually are able to get exactly what you put into it back at year 20 and year 25. So they'll allow you to walk away from the policy at that point if you choose to do so, and you're getting either the minimum of what you put into it or the cash value, whatever's higher. So at year 20, in this illustration, it's actually showing 168,000 in the net cash value, surrender value for that policy year 20. So you actually are going to get the higher of the two. Travis, you want to go to year 40, the 44-year-old?
Yeah. All right.
So typically what we would recommend if you're on active duty is let's get an insurance policy in force that's term. That way we know what you are insurable at. We know what your cost is going to be when you get out and retire. And typically once you're settled in 3, 4, 5, 6 months later after retirement, you have your second job is when we would convert that to a permanent policy. But go ahead, Travis.
All right. I'm highlighting the same thing from the prior slide. There's the death benefit right there. I'm sorry, the monthly premium right there, $1,022 a month. And then right here, year 20 and year 25, how much you can get back. And this one also stop paying into it at age 30, 73 years old, $368,000. That's how much it costs. And by year 25, by year 25, they should have more cash value than premiums paid into the policy. And this one by age 85, they got about $813,000. And this one, same, the 1.2 million, this level death benefit. But you can do increasing as well. There's options with this. A lot of flexibility.
And Donald, you had a great question, and this is really the reason why, like for my own personal retirement, my wife has this type of policy. I have a whole life policy on myself. We are consistently borrowing from it, and yes, you can borrow from it tax-free. There is a interest rate that you paid. So with the whole life policy, you just pay the insurance carrier back that insurance rate of, let's say it's 4 or 5%. You're going to pay that, but we use it for our investments. So if I can do an investment that's going to make me, 10% or higher, which again, if these aren't guaranteed, and this isn't investment advice on this, but if you can do that, then that arbitrage is a lot different. With the index universal life, when you borrow from it, you actually have an option where you can still earn money like you never borrowed it out of the policy. So life insurance is one of the only vehicles where you can have your money growing in 2 different places. I'll say that again, your money can grow in 2 different places because when you borrow from it, so let's say where Travis at highlight age 25, Travis, that one, like you have the 375,000. If you borrowed $350,000 at that moment, if you look to next year, that path won't change. It will still be worth 401 the next year as far as on the income level, but the account value never changes. So you can take that money outside of your policy. It does lower your death benefit, but you can use that as an outside investment and invest it anywhere you want to use, whether it's rental properties, whether it's paying off debt. We normally look at, make sure you're not just using it to buy something, unless you're at this point in your life where, I don't care about this policy. Our investments are doing great. We don't really need all this life insurance. Let's start using some of the money now. And we do have ways where we can show you how you actually can take loans out every single year and use it as almost an additional pension for you as well. Yeah, Don, 100%. I mean, I'd love to chat with you about that. It's one of my favorite strategies is using life insurance as leverage. This particular policy that what we have here was more designated more for the guarantees, but for those that want to use it as a vehicle, like I had one of my clients as an example. I mean, they went out and they do very, very well for themselves. You know, some of them put 70, 80, $90,000 a year into life insurance because they can borrow it out in the future. So a lot of different things to kind of talk about when it comes to strategies. And the other thing when it comes to why we always recommend taking the veterans group life insurance is to go back to that whole life example, Travis, is giving you the flexibility that in 5 years from now, if you're out in corporate America or you're an entrepreneur and now you're making way more money than you've ever made in your life, you also need to protect way more money than you ever made with your life. So those are different things where we like to have our clients have that different flexibility. Are there any other questions? Donna, great questions, man. Thank you so much for all the questions you've had. Any other questions? Let me just go back to, again, we'd love to connect with you. You can reach us at 866-971-6221. Those are in listen only. Let me go back and just share. And this is, again, our contact information. I believe we've linked, connected with everybody on LinkedIn. You can also reach back to us on LinkedIn. Is there anyone else that would have any other questions? Prefer to come offline with questions?
Rebecca, definitely. Yeah, let's reach out to Rebecca, and yeah, I think that's it.
Yeah. Well, thanks again for everyone for spending
Thanks for coming.
Post-lunch hour
on the upcoming retirement. Sorry, Michael. My bad.
Go ahead, Travis.
I said thanks for coming and congratulations on the upcoming retirement. Welcome to the club. It's awesome on this side. You just got to get set up first, and then it's awesome. The first 3-6 months, year, it's kind of crazy, but after that, it's awesome.
Excellent. Well, thanks everyone. God bless and have a blessed rest of your day. And thanks for your service, everyone. God bless. Bye-bye.